Hi students, today we're going to talk about chapter 4, which is the closing process. Now what we're doing here is closing all of the temporary accounts so that we can prepare our financial statements and then we can start over our accounting records with zero balances in those temporary accounts. Remember, our temporary accounts are our income statement accounts, revenue, all the revenue accounts, all of the expense accounts, and then the drawing account. The assets, the liabilities, and the capital accounts are all considered real accounts, permanent accounts, and they are not closed. For instance, if you have a loan at a bank, just because you go through the closing process does not mean that you still don't owe that money as a liability. Also, the amount of cash you have in the bank does not change simply because you go through the closing process. So we're only going to be closing revenue, expense, and drawing. Okay, there are 4 closing entries, and that's what you need to know. Try to remember that there are 4, so take them step by step. Step 1 would be to close all revenue accounts into another temporary account that we're going to call income summary. Income summary is only opened at the end of the accounting period and it is closed at the same time, but it does help us to accumulate revenue and expense so we can come up with our net income or net loss. Okay, the second step would be to close all expense accounts into income summary. Then once you get those accounts closed, you have a balance in income summary, either a debit or credit, depending on whether or not you have net income or net loss. If you have net income, you would have more revenue than you have expenses, so your balance would be on the credit side. If you have a net loss, you would have more expenses than revenue, so your balance would be on the debit side. But whatever that balance is, you're going to close it into capital. Remember, everything's going into capital now. And then the last step is to close your drawing account into capital, and we'll be back to the balance sheet accounts, assets, liabilities, and capital, back to our accounting equation. Okay? So we're going to be closing those temporary accounts. Now looking at the first one, all the revenue accounts are going to have credit balances. Fees earned would be 1, and sometimes that's the only one you have, at least in this level of accounting that we're doing right now. So let's say we had a balance in fees earned of $150,000. Okay, over here we're going to have our income summary account. Alright, so our entry would be, to close the account, your entry is always going to be the opposite entry or of the balance that you have, because to close it we would have to debit it, and that would bring our balance down to 0. So that first entry would be to debit. Oh, I don't even have to put debit up here, you know what the debit is. You're going to be debiting fees earned and crediting income summary. Now notice when we credit income summary, that shows revenue. Right now that's all we have in it. I'll put it in just a moment. Right now that's all we have in the income summary account. And if that's all we had, that would represent income, net income. But we're going to go ahead and close the expense accounts now. So I'm going to erase this for now. And let's say our expense account would have a lot of different ones, so you have to close each one individually. Now keep that in mind. In your journal entry, you've got to debit or credit all of the revenue or expense accounts to get them closed. Don't just say debit or credit revenue or debit or credit expense, because that won't get the accounts closed. You've got to close the individual accounts. So let's say salary expense. We've used that one before. And that account has a balance of, say, $50,000. Now, in order to close that expense account, we're going to have to credit it, aren't we? So we're going to put a credit over here of $50,000 to get that balance down to 0. And our entry would be a debit to income summary and a credit to salary expense. And that would be for $50,000. Now we're going to assume, for purposes of this video, that that's all we have, but of course we would have more. So we've already closed it here, and we're going to put that over here on this side. And now we're down to closing income summary. That's our third step. So here, what is our balance? We have a credit and a debit. So we have a credit balance of $100,000. Okay? All right, now I'm going to have to erase some of this so I can get the last two entries on. So I'm going to erase these. And the third step would be to close income summary into capital. And always use the name of the sole proprietor when you're looking at that capital account. So we'll call this B. Fowler Capital. Okay? All right, the third entry then would be a debit to income summary because it has a credit balance. That would get us down to 0. Okay, and we're going to be, since we're debiting income summary, we're going to credit capital. So we have a debit to income summary. And a credit to B. Fowler Capital. And that was $100,000. Okay, so I'm going to put that one, well, we've already put it there, so you have it in T account format, and then you have it in journal format. And the only other account that we haven't closed that needs closing is drawing. So I'm going to erase this now since it has a 0 balance. We put our drawing account up. Let's say that the owner, me, has taken out $20,000 this year, or this period. Now we know that the drawing account has a debit balance. So to close the drawing account, we need to credit it, and we're going to debit capital. That brings our balance to 0. That's what we want to do. And now our balance in capital is $80,000. We might have had a beginning balance there, but I didn't include that. In journal format, that would be a debit to B. Fowler Capital and a credit to B. Fowler Drawing. For $20,000. Okay, so those are your 4 closing entries. There are only 4. Remember, the closing entry is the opposite entry of what you have in the account, so don't get confused on that. What you're trying to do is get that account down to 0. Okay, so you have to make whatever entry it takes to get that account down to 0. And that's really all you have to closing entries. Now, there's a lot more in the chapter. There's a lot of discussion about worksheets. I'm not going to cover that here. But you can either get your closing entries directly from the worksheet, or you can get them from the trial balance. That would be the adjusted trial balance, because remember, you're going to do a trial balance after every time that you do transactions or adjustments. And then at the very end, after you do your closing entries, you will do a post-closing trial balance. And on the post-closing trial balance, all you will have will be the assets, the liabilities, and the capital. Okay? Remember, the purpose of the trial balance is to make sure your debits and credits balance in your ledger so that you haven't made any mistakes there. But also remember that a trial balance will not find all errors. Okay, let me know if you have any questions.